For many companies today, M&A is a critical path to both growth and competitive advantage. This quarter, we sat down with Brian Heckler, a senior partner here at KPMG who specializes in the M&A arena. We wanted to get Brian's thoughts and perspectives about the current M&A landscape, what some of the key considerations are when evaluating a transaction, what some of the common pitfalls are in terms of post-mortems and the like, in terms of evaluating deals, post-integration plans and the like, and how audit committees and boards can help their companies maximize the value of a deal. So here are the highlights. This is a difficult area for a lot of companies, Brian. As you sit there and you think about it, I keep hearing, I'm sure you do, there's a lot of cash on the sidelines. Companies are looking to deploy that cash. They potentially look at M&A as a growth area for their company. But we also know the playing field is littered with failed deals. People are also asking themselves, do they have the right competency and expertise in their own organizations to deal with the transaction? It's one thing to go through the financial analysis, the assumptions, wholly different to deal with integration issues. So before we delve into the specific items of interest from an audit committee and board perspective, maybe you can step back and take a look at the overall landscape for us. Is M&A about to take off?
There is a lot of money on corporate balance sheets and dry powder in private equity, so there's a lot of capital ready to be deployed. Companies are struggling finding great places to deploy that, both internally, so you see a lot of dividend programs and share buybacks, as telltale signs around that struggle. But if you look at it, there seems to be an uptick in confidence, and we'll go through some facts here in a minute. And there continues to be the need for companies to constantly add competency, enter new geographies, get new technologies. People accelerated a lot of deals into the end of last year's, the final quarter, around the concerns around capital gains tax increasing, around some of the other wealthier tax rates going up. So we saw a lot of deals get pulled into the fourth quarter. And so there was a natural kind of drop in the first quarter. Corporates have a lot of cash, but we're also now starting to see private equity get back in the game. Borrowing rates are still very low. There's a lot of available capital, both dry powder and debt financing. And if you look at what happened in our business, which is a leading indicator of diligence and things that happen way ahead of time, around the last week in April, we saw a significant uptick in volume.
So as you sit here and you evaluate the landscape, are we looking at M&A as a path to growth? Or, and I think you may have alluded to this a little bit earlier, are you doing more of a strategic assessment from a company vantage point and looking at either product areas or strategic gaps, geography or otherwise, and looking to fill in your proposition to the markets? What are you exactly seeing?
What we're seeing is people are recognizing that they have challenging profit horizons within a slow growth economy. And one of the things that they've identified is divestitures as a tactic to help facilitate meeting those profit objectives.
So rationalize their portfolio, right, exit periphery activities, and get back, right, to your mainstream activities?
Partly the non-core, but I think it's even more fundamental than that. The underperforming business units, people are looking to pull them out of the portfolio and get that capital back in the hands of shareholders to increase returns. So that's one trend. The other trend is we see that technology and the embedding of technology in product, non-traditional technology products, is accelerating the rate of change in products, and it's accelerating the need for new competencies.
What are you seeing in terms of how people are approaching the due diligence exercise? Financial assumptions, integration, et cetera.
It really is a case-by-case basis. What we find is when you don't do diligence, the risks around failed M&A go up dramatically. And the way in which you do diligence really influences that. So having a robust process for corporate M&A activities, a robust program on how one assesses risk, how one screens targets, how one does valuation, and then having an objective challenge of that, those aspects, and whether it's legal diligence, financial diligence, operational diligence, HR diligence, or even cultural diligence, which is probably one of the most underserved areas of diligence. Those tend to be the success factors. When people have more robust programs, they tend to have a better chance at getting it right. It's amazing the divide between the thesis on cost synergies and the reality of what happens. Too often, companies then have to get into the next deal or the next operating crisis, and the integration plans get thrown by the wayside and are never executed upon. And that's probably one of the most important root causes we see around underperforming M&A, is the synergies that were contemplated are not executed upon. There aren't robust measures for whether you're achieving these synergies and whether you're achieving that operating performance, or the realities of trying to integrate are much more complex and harder than was ever envisioned.
I mean, one of the things that we tend to see is companies falling in love with a deal. And I think, one of the primary purposes at the board level is to make sure that a potential transaction is wholly aligns with the strategy of the company, and really making sure that there's an objective evaluation element to the deal itself, that management's not falling in love with the deal, the financial projections themselves are not too rosy. I also think at the board level, it's really important to be able to say, this is how we're articulating the value for our people and our shareholders, and this is actually how we're going to monitor it on a go-forward basis to ensure that we're actually delivering against such value. And one of the things that we see from a board perspective that's particularly important is to take a hard look at the post-merger integration plan. I mean, is it substantive enough? Is it timely enough? The board might have the overall responsibility, so to speak, in terms of alignment with the company strategy, et cetera, and making sure that the value's there. But they delegate to the audit committee taking a harder look at some of the financial assumptions and really getting into the details of not only the economics and, as you say before, cash flow, EBITDA, and et cetera, but also looking at the essential elements of the integration plan. When you're talking about integrating a new company, take a hard look at the compliance risks. We're all dealing with increased regulation. And once you buy it, you own it. And once the deal has been executed, effectuated, having a disciplined process to monitor that post-integration plan, a post-acquisition integration plan, including having necessary and appropriate milestones to gauge performance and progress. Well, I think the last point I'll make here, and now we'll move forward, is don't fall in love with the deal. Because if you fall in love with the deal, a lot of the things that you talked about, you might only get a cursory glance at it, but if you look at the failed transactions in the marketplace, there is a correlation. When you fall in love with the deal, you generally have problems after the fact.